Hello traders, Gary Wagner here, approximately 10:30 in Honolulu, making it 3:30 in New York. It is Wednesday, the 24th day of October 2012, and this is the daily report for gold and silver. Following statements made by the FOMC meeting, we have gold and silver slightly off their lows. In trading today, we do have a mixed bag with gold still trading lower on the day and silver trading higher. Currently, as you can see, continuous contract December gold 1702.80. It has had a low of 1697.20 and a high of 1713. Unlike gold, we do have silver higher, nominally higher this morning, up around 10 or 12 cents on the day. As you can see, current print 31.77. It has had a low of 31.44 and a high of 32.15. You know, not really unexpected, but coming so close to the election right now, the statements made following the monthly FOMC meeting and minutes read really show the Fed staying the course right now in terms of QE3 or quantitative easing. And that monetary policy, of course, is bullish on the precious metals. And as you can see, we have been hovering that $1,700 mark in gold. Psychologically, it is a pretty important number, even matching our Fibonacci retracement as we've talked about over the last couple of weeks. And the one thing that's clear to me is that if in fact we can see the market hold in this area, we could get a nice bounce. On the other side of the fence, if in fact there is continued downside pressure, my sentiment is that there really isn't any strong superlative support really until we get to around 1634. That's this 38% retracement level right in here. I personally have told you, I'm on record as saying that I believe the 1700 area should in fact hold. I have seen no technical evidence to refute that belief or to cause me to change that assumption, but it has been teetering ever so closely, really right within this area. You know, I find it quite interesting. If you recall some of my shows from a couple of weeks ago, 2-3 weeks ago, and 4 weeks ago, of course, we're now looking at a weekly chart of gold. This is the cash market of gold. We, of course, pointed out and talked about the fact that we really had some real resistance at 1800. Can be no doubt about that. We also pointed out the fact that what we were really trying to discern was within the marketplace itself, we were uncovering, detecting these dojis that can appear at the top of a market, but in gold, they also appear when the market's consolidating. But the fact that we got really two of them followed by, I believe I said, a shooting star-esque. In other words, it's very close to the formation of a candle called a shooting star. However, in a shooting star itself, the key difference, of course, is this tail. The tail in a classic shooting star needs to be a minimum of 2 to 3 times body size. So you would get on a shooting star a much larger tail. We, of course, didn't get that. But what you can see is this tail, smaller body. This was, of course, just coming after a couple of dojis. And then we got this 2-day pattern simply called an engulfing bearish. The engulfing bearish really gave us a clue. And we got the confirming candle last week when we had this down week. Now, this would simply be called a continuation of the correction which began roughly $100 ago. We saw this market has been coming down pretty aggressively over the last 3 weeks. But here's what I'm finding interesting, and that is, at least on a tentative basis, and you can see on this particular Fibonacci retracement, I'm working from this low right in here. That low is fixed at, I believe, 29.1529 up to almost 1800. In terms of the retracement we've seen from that market move, we've retraced now about 38%. 38%, 1695 on this. As I say, it's roughly around the 1700 mark. And then the next mark is 50%, 1663. And then the 61% is 1632. And the 1632 is that very, very strong retracement. You can get a wave two that actually comes down that hard. That is, in fact, one primary model in Elliott Wave to see a very, very sizable correction after your wave one, and just, of course, prior to the market moving back up and going back into an impulse phase in that intermediate wave three. But you can see this. When the market went through, for example, the 23% retracement on a weekly chart, you can see that it just went through. Now, of course, we are only midway through the week. Anything can happen, and this, in fact, could go through this particular point. But right now, on a tentative basis, it is holding above 1700, and the question obviously is, will that remain? And that's something we'll just have to see. If not, the next levels that we would look for in terms of this market to correct would be, of course, I talked about 1664 being primary. Secondary, you do have a few tops up here at about the 63 level. I still consider that to be fairly minor because I see this breakout, and this is the breakout, of course, that got us long on really our second most profitable trade of the year. First one taking place on January 2nd, and then this one. These two trades themselves have been very, very, very good to us in terms of the market moves itself. This is that one move that we saw. We captured over $100 on that. We captured over $100 on this. And the key is really to be able to weather these corrective phases in between those nice impulse runs, because, of course, the impulse runs are where I'm looking to capture as much as we can out of that market. The $64,000 question is obviously properly identifying when one wave concludes and another begins. And as an armchair quarterback, meaning when I look back at it, it's quite easy. In the heat of battle, of course, it is a much more difficult task. You know, silver has really been pretty dynamic. In one hand, we've been able to get the positive effects on these bullish rallies in gold. Silver has typically outperformed gold. On the downside, it's tended to come down a little bit more difficult. But on days like today, you get a divergence, a difference in which you'll get silver moving higher. Silver, in my opinion, has got some very, very strong potential right now. And it's simply a matter of it finding a correct support area. As you can see, we are 31.75. We have our stops below this area. This is that 47. I believe our stops are at below 35. So we've been safe there. The question is, of course, will the market be able to hold? And one thing that you can see, let me go ahead and blow this up, is that on a couple of occasions, this, of course, is a intraday chart, 240 minutes, much more short term than our longer dailies. But you can see that we've had a couple of stabs at these particular areas right in here and in here, and the market has found buyers. The market has been resilient, and we've seen the market, of course, move up from that point. So, like gold, we are at some critical areas in terms of support. The question is, will those support areas hold? That's a question that, honestly, only time will answer at this point. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow on Thursday for another daily update and review. Bye-bye.